Hello, class, and welcome to our lecture series number 13 of Financial Accounting or Principles of Accounting. And I'm your instructor, Dr. Jamal. So today we are sharing light on the accounting for liabilities. So we have divided these liabilities into two lectures. One lecture is about current liabilities, and the next lecture is about long-term liabilities. So up till now, we have covered the asset side of our balance sheet, and now we are on the right-hand side of the balance sheet, which is liabilities plus on equity. So we'll cover these. Okay. So our first learning objective is account for current and contingent liabilities. So let's just start that. There we go. So there are two categories of current liabilities. Number one, liabilities with known amounts and liabilities with estimated amounts. So as we know that current liabilities are those which are to be paid less than or equal to 1 year. Or if your operating cycle or if your financial year is more than 1 year, then of course less than or equal to financial year or your accounting year. All right. So we have two kinds of current liabilities, known amount in which we have set figures. For example, okay, I need to pay 10,000 to my suppliers. So amount is known, but some liabilities we estimate the amount and we see over there. So just going to give you a little bit taste of this concept. For example, warranty claims. We don't know how many products going to be defective and how many customers are going to claim the warranty, plus any lawsuits, legal suits, right? Any legal matters. If we win the case, right, we don't have to pay anything. But if we lose, we have to pay this. And how much? The court will decide. All right. So these kind of liabilities, we have estimated amount. So the accounting treatment for these two current liabilities, these two types of current liabilities are different. So let's just find out number one, the treatment for number one, which is current liabilities of known amounts. So which includes accounts payable, which are suppliers, short-term notes payable, sales tax payable, accrued liabilities. What do we mean by accrued liabilities? That liabilities has occurred but not yet paid. For example, wages, right? Rent. So these kind of stuff. So when you finished, or maybe the work done, and now amount is needed to be paid. So we call this accrued liabilities. Expense occurred but not paid. We call this accrued liabilities. And then we have payroll liabilities, in which we record all the wages and salaries of the people. So big companies, because they want to track their employee expenses, salaries, wages, so they want to know separately that what is our total expense related to payments of wages, salaries, it's like that. So we create a payroll account. It can be under accrued liabilities if you have tech industry in which you don't have many employees, but if the manufacturing companies or the software companies in which the most important assets are people, so they want to know that how much costly for them to retain the people and what are their salaries, this kind of stuff. So they create a separate payroll accounts for current liabilities because they want to know how much is their expenses related to employees and how much they need to pay at the end of the month. All right. And then we have unearned liabilities. We already talked about that in our chapter in which we talk about the adjustment entries. What is the unearned revenue? Unearned revenue is when you receive the amount of revenue, amount of sale in advance, but possession is not transferred to the, or ownership is not transferred to the customers. So things or your goods still in your godown, still in your possession, still in your stock, and you receive advance sales. So it means you receive cash in advance, and because now you need to deliver the services, so we create liabilities as unearned liabilities. So this is not sales. This will not go to income statement. Rather, it will go to balance sheet under current liabilities, and specifically current liabilities with known amounts. All right. And then we have current portion of long-term debt. So at its name employees. So we have a long-term debt, for example, for 5 years. So every year, so for example, you in total you have a 500,000 loan, and you have terms that every year you will be retiring 100K. So this portion that is due within 1 year, this is under current liability. So all of the left is 400,000 is still a long-term debt, but whatever we have paid, the current portion, that would be our current liability, because its life is less than 1 year. It needs to be satisfied, it needs to be paid less than or equal to or under the financial year. All right. So let's see the current liabilities of known accounts one by one. So I just gave you the overview. So accounts payable, we already talked about, numerous times under numerous journal entries, the accounts payable. All right. So it is the amount owed for products or services purchased on account. You are purchasing raw material or inventory to be resold to the, to your clients, or services that you are taking from your suppliers, and you are paying them later. So this is not backed by cash. All those raw material or materials or inventory purchased from cash are not recorded under accounts payable, because accounts payable is created when you still need to give the money. All right. So accounts payable generally are suppliers. If you are uh, manufacturing or trading company, then you will record your accounts payable. And if you are a service company, you also recorded their accounts payable. But in that case, you receive the services, you are using those services, and you are paying for services. For example, in investment management, what are the accounts payable? The reports, the market analysis that a company get from the third party, and then they sell to their clients as decisions, or buy this stock or sell this stock to their clients. So all those advices that they give to their clients on the basis of services provided by third parties. So in that case, their supplier is providing them services. All right. So accounts payable is created in both manufacturing and service company, also trading company as well. All right. So common transaction is, if you purchase inventory, what is the journal entry? Simple. Inventory increases, it is debited, and accounts payable increases, is credited. All right. So that rule of our debit credit is still there. So if asset increase, debit; if asset decrease, credit. On the other hand, on the right side of the equation of balance sheet, if liability increase, credit; if liability decrease, debit. And our entry, how we pronounce the journal entry, from debit to credit. So if we purchase inventory on account, credit purchases, the entry going to be inventory to accounts payable. All right. So this accounts payable is can also be used as a control account, or as you can so as a measure of liquidity. For example, accounts payable turnover, which means number of times a year company is able to pay its accounts payable, which means basically this is a finance terminology. We will not discuss in detail, but just going to give you a taste here. So an accounts payable turnover, which means sales or CGS divided by accounts payable. So it shows that your sales are how many times of the accounts payable, and if you divide 365 number of days divided by accounts payable turnover, it will tell you the number of days that you are paying back the money to your suppliers. So it gives you the liquidity condition, that are you paying early to your suppliers or are you paying late to your suppliers. Of course, it has the financial implications. If you are paying late, so your suppliers are not going to be happy, and other liquidity issue is going to be raised. So back to our accounting treatment for accounts payable. Let's move forward. So when you purchase inventory, remember inventory increases, so that will be written on debit. So if you see the inventory account, T account, inventory increases. So when it increases with two accounts. Number one, the balance from the previous month or previous year, and then the new balance which is debited when you purchase the inventory. All right, and inventory is decreased when you sold the items. When your sales increases, your inventory decreases. All right. Now, if you understand the concepts here, so let's just talk about this. Purchasing much than inventory on account results in an accounts receivable. Is true or false? Haramina? Miria, Joao Paulo, Faik, Mirko, Sufyan, Ten, Venetia, Subhan, Noon.
Yes.
True.
It's
true or false?
when you purchase stuff on account and you didn't pay them yet.
Is it true or false?
True.
False.
Wait, what?
Think about that.
Should be accounts payable.
We just talked about that. Accounts payable, not receivable. Accounts receivable are created when you sell them. These are called customers. So when you purchase inventory, remember, on account, your accounts payable increases, not account receivable increases.